So, good day everyone. So, right now we'll talk about the government budgets and its fiscal policy. So, government spending plays a crucial role in country's economy. It helps fund essential services such as national defense, healthcare, and social programs. So, however, the government must balance its income or the taxes and expenditures to maintain financial stability. So this report explains the key concept of budget deficit, budget surplus, and a balanced budget, as well as the major categories of federal spending. So first, let's talk about the government spending. So the federal government manages its finances through tax revenues and expenditures. So depending on how much it spends versus how much it collects in taxes, it can have a budget deficit, surplus, or balanced budget. So first, let's talk about budget deficit. So it occurs when government spending exceeds tax revenues in a given year. The government must borrow money to cover the shortfall, often by issuing bonds. And next is the budget surplus. It happens when a tax revenues exceed government spending and allowing the government to pay down debts or save for future needs. And next is the balanced budget. When balanced budget is when government spending and tax revenues are equal or meaning borrowing is needed. So major federal spending categories in government spending is divided into different programs that serves public needs. So the largest spending areas include first the national defense, which covers military operations, weapons, personnel, and national security efforts. And second is social security, which provides retirement benefits, disability income, and survivor benefits to millions of citizens. And third is the health programs, which includes Medicare for seniors and Medicaid for low-income individuals, as well as other healthcare related expenses. And last is the interest payments, where money paid on the government debts, which grows when the government runs deficits and borrows more. So now let's talk about the deficit versus the debt. So let's understand its difference. So many people confuse deficit and debts, but they are not the same. While both related to government finances, they measure different aspects of fiscal policy. So government deficit or surplus, a deficit occurs when the government spends more in a given year than it collects taxes. So a surplus happens when the government collects more taxes than it spends. So the deficit or surplus is calculated annually as part of the federal budget. However, on government debts is the total amount of money that the government owes over time. So it is the accumulation of all past deficits minus any surpluses that have been used to pay off debt. So if the government runs a deficit every year, the debts will keep growing. So now let's move on to the taxation, federal and taxation trends. So first we'll talk about the federal tax. So revenues over time tax revenue has ranged between 17 to 20% of GDP for most of the period since 1960. So there are fluctuations in total federal tax receipts, so reflecting changes in the economy, government policies, and tax laws. And second is the primary sources of federal tax revenue. So the government collects taxes from different sources. So the most significant ones are individual taxes, which are the largest share, collected from wages and salaries of individuals. Second is the payroll taxes, specifically used to fund social security and Medicare. And Second is the corporate income taxes paid by businesses, but this declined as a share of GDP over time. And the last one is the excise taxes, or taxes on goods like fuel, alcohol, and tobacco. So next is the taxes collected by the federal government. So first is the individual income tax. So it is a tax based on the income of all forms received by individuals. And next is the payroll tax, where a tax based on the pay received from employers. So these taxes provides funds for security and Medicare. And next is the progressive tax, a tax that collects a greater share of income from those with high incomes than from those with lower income. So what the Philippine income tax is: marginal tax rate, where the tax rate an individual would pay on one additional dollar of income, where the tax percentage on the last dollar earned where currently ranges from 10% to 35%. So a proportional tax is about it is a tax that is a flat percentage of income earned regardless of level of income. And regressive tax, it is a tax in which people with higher incomes pay a smaller share of their income in tax. And next is the corporate income tax. So it is a tax imposed on corporate profits. And excise tax is a tax on a specific good, like on gasoline, tobacco, and alcohol. Thus, an estate and gift tax is a tax on people who pass assets to the next generation, either after death or during life, in the form of gifts. So now let's talk about the state and local taxes. So the revenue sources for state and local governments are sales taxes, property taxes, revenue passed along from federal government, and personal and corporate income taxes, and also a variety of fees and charges. So now let's talk the federal deficits and national debts. So the government manages its finances through revenue, or the tax collected, and spending money, or money spent on programs like services and operations. So when the government spends more than it collects in a year, it results in a budget deficit. If it collects more than it spends, there is a budget surplus. Diba? Para sa kung kanina about anong deficit and surplus. So a budget deficit increases the national debts. If the government runs a budget surplus, it can reduce the national debts. So the national debts grows as the government borrows money to cover its spending. So now let's talk about the fiscal policy to fight recession, unemployment, and inflation. So understanding fiscal policy and its impact on the economy. So fiscal policy is how the government adjusts spending and taxes to influence the economy. It can be used to combat recession, unemployment, and inflation. So there are types of fiscal policy. We have here expansionary fiscal policy, which boosts the economy. So its purpose is to stimulate economic growth, reduce in unemployment. So how? So let's talk about increased government spending. For example, the infrastructure projects and social government. So it cut taxes to increase consumer and business spending. So when is it used? So it is used during recessions or periods of high unemployment. Second is the contractionary fiscal policy. So this slows down the economy. So its purpose is to reduce inflation and excessive economic growth. So how does this happen? So it decreases government spending. For example, cutting public programs. So it increases taxes to reduce consumer spending. So when is it used again? So it is used when inflation is too high and the economy is overheating. So for example, last 2008 to or between 2008 or 2009, the US have financial crisis. So the US government implemented expansionary fiscal policy where they stimulus packages or they cut their taxes to recover from the recession. So fiscal policy is the government's use of spending and taxation to influence a country's economic activity. It includes both expansionary policies used to boost growth during slowdown and contractionary policies used to control inflation during rapid growth. So by adjusting public spending and taxes, fiscal policies plays a key role in stabilizing the economy and promoting employment and maintaining price stability.
Let us now move on to the next slides where I will discuss discretionary fiscal policy and automatic stabilizer. So, discretionary fiscal policy refers to the government actions that requires passing new laws to adjust tax rates or government spending. So, ang purpose aning nga policy is to influence the economy intentionally, especially during recessions or inflation. So, one of example of this is during the COVID-19 pandemic, the Philippine government passed the Bayanihan to Heal as One Act, which allowed large-scale financial assistance to citizens, health workers, and businesses. This is an example of discretionary fiscal policy because it required new laws and actions to boost the economy. Second is the automatic stabilizer, which refers to the built-in tax and spending rules that automatically adjust with the economic situation. No need for new laws. So, ang purpose aning stabilizer is to soften the impact of economic fluctuations like recessions or inflation. So, one of example ani is unemployment insurance. When more Filipinos lose jobs, more benefits are automatically paid out. Another example is income tax brackets. When income drops, people automatically pay less tax. So another example of automatic stabilizer is food subsidies like Pantawid Pamilyang Pilipino program also act as stabilizer by continuing or increasing during downturns without needing new legislation. Next is standardized employment budget. So it refers to the budget deficit or surplus adjusted as if the economy is always at full potential employment. So the purpose of this is to remove the effects of automatic stabilizer. Then it also helps compare the government's actual fiscal stance, excluding temporary effects of the business cycle. So now I'm gonna show you a graph that explains the actual deficit surplus and standardized deficit or surplus. So in the graph, you can see two lines. The broken lines is for standardized deficit surplus. The other one is for the actual deficit or surplus. So actual deficit includes the effects of automatic stabilizer. Standardized deficit shows what the budget would look like without those automatic effects. So like for example, in the Philippine context, when the economy enters a recession like during typhoons, COVID-19 lockdowns, or global oil shocks, so dira musod ang automatic stabilizer, which is more people get cash aids and food subsidies, and also the government collects less tax as income and spending declines. So as a result, the actual budget deficit grows, but the standardized budget shows a smaller deficit, revealing that much of the deficit is due to the temporary economic condition, not poor fiscal management. Next is I'm going to tackle the practical problems with discretionary fiscal policy. But before that, let me explain first the interconnection of fiscal and monetary policy. Always remember, fiscal and monetary policy is always interconnected. So when we say fiscal policy, it refers to the government spending and taxation, and monetary policy refers to the central bank actions like setting interest rates. Then, one example of that is if the government increases spending or fiscal expansion, it might increase demand for money or borrowing, which can push up interest rates, interfering with monetary policy goals like controlling inflation. That's why fiscal and monetary policy is always interconnected. So now I'm going to discuss the problem of discretionary fiscal policy, which is crowding out. It is when the government borrows heavily to fund its spending. It competes for financial capital in the market. So let's say, for example, in the Philippines, government increases spending on infrastructures projects like build. So borrowing from local banks, then bond markets to fund it. So, as the government borrows more, it increases demand for loanable funds that leads crowding out. And the effect of that is private spending and investment, potentially weakening the positive effects of government spending. Next is long and variable time lags. So fiscal policy doesn't take effect immediately because of three K lags, which is recognition, legislative, and implementation lags. So when we say recognition lag, time it takes for government and economists to realize na ang recession is already happening na. One example of this in the Philippines, economic data is often released with a delay. So it might take months to confirm the GDP has dropped significantly. So second is legislative lag. So time needed to pass a new fiscal policies law through Congress. So example, during the pandemic, the Bayanihan Act took time to pass despite urgent need for cash aid and medical funding. So the third is implementation lag. So even after law passed, getting funds to agencies and launching programs takes more time. So example, some Filipino families waited weeks or months to receive ayuda or financial aid, delaying the intended economic relief. So overall, these logs mean that by the time the government acts, the economy may already be recovering, reducing policy effectiveness. Next is the question of a balanced budget. So discussion questions, what are the arguments for and against requiring the US federal budget to be balanced? So arguments against requiring a balanced budget, especially in the short term. So during short term, the economy naturally goes through ups and downs. So in recession, it is normal to run deficit to support people and the economy, like for example, during pandemic, so the Philippine government increased its spending on the healthcare, aid, and economic recovery efforts. So this led to a larger deficit because the government had to borrow money or use reserves to cover the extra cost, even though it wasn't collecting as much tax revenue due to slow economic activity. And for the short term, during booms, government can collect more taxes and run surpluses. Then for the long term, especially in 2020, the Philippines ran a larger budget deficit due to heavy pandemic spending. This was necessary even though it wasn't balanced. So the arguments for allowing deficit in the long term, the Philippine government deficit can finance productive investment like in education. The Philippines provide or give more scholarships than mga TES programs. Then also, the government build infrastructures like bridges, roads, farm to market roads. So, kani nga mga build long term, it gives national productivity which helps the economy grow. So, the key points of balanced budget is if the constitution or law required the Philippines to balance its budget every year, it would limit the government's ability to respond to crisis or invest in long-term development.